Welcome to Keyfest 2021, presented by Casa, the best in Bitcoin security. My name is Nick Newman, and I'm the CEO at Casa, and I'm excited to welcome you to a few days of discussions and workshops where we're going to teach you about the power of private keys, both in Bitcoin and beyond. In 2020, Bitcoin hit all-time highs. Institutional adoption has swelled to levels we've never seen before. And amidst a global pandemic, the Bitcoin community has grown substantially. At Casa, we believe that private keys are a fundamental building block of Bitcoin that all new Bitcoiners should understand. We created Keyfest as a fun and educational way to spread that knowledge. Keys are the foundation of everything we do in Bitcoin, and they're inherently very personal. At Casa, we're building a personal key manager that allows you to take control of your financial life. Your private keys allow you, and only you, to have direct ownership of your money through Bitcoin. At Casa, we help you secure these keys so you can live your life with the peace of mind that your Bitcoin is secure. Welcome back to day 2 of Keyfest. Today, please welcome Elise Colleen, founding managing partner of Stillmark, and Caitlin Long, founder and CEO of Avantis Financial, as they join me for our next conversation, the bull run for custody, how the many options for custody have changed the game for Bitcoin investors large and small.
I'm honored to be here today with Nick and Caitlin, two of the folks really leading the way on the maturation of custody. And as custody is one of the core enabling technologies for Bitcoin adoption, it's a particularly important subject to cover in today's market, given that we're entering what looks to be an exciting bull market. So in the bull market of 2017, custody wasn't quite at the state that we find it today. And so I'm excited as I'm getting pinged by friends and family entering Bitcoin for the first time. The way we know we're in a bull market often is that we start hearing from friends about where should I buy, how should I secure. And today in 2021, it's exciting to have better options, better UI, UX, better security teams to kind of guide them through that process. And I wanted to start there. Caitlin and Nick, can we start with just a general overview of what the custody space looks like today from a user's perspective? Maybe I'll throw that to you first, Nick.
Yeah, sure. So I think that there's from a very high level, there's two paths you can go with custody, and that's either self-custody or using a custodian. And so if you want to think about that in kind of normal non-Bitcoin terms, that's basically like keeping cash in your wallet or keeping cash in a bank. And so there's really many different options here for the different types of products and companies that you can work with, both on the self-custody side and on the custodian side. And what's really interesting to me is that over the last couple of years, since the last time we really went or had a bull run with Bitcoin, is that the options for custody have just evolved significantly since then. And some really interesting new options, both like Casa and Avanti, have popped up that really just weren't around in 2017, which allows a much broader range of individuals to be serviced.
Right, exactly. Caitlin, do you want to weigh in here too and perhaps give us some insight into the products that are new for this part of the market cycle? What do we have today that didn't exist in terms of specific products in 2017?
Sure, we certainly have a lot more today. One of the products is Casa. Multi-sig was relatively new back then and untested, and you had to be an engineer to be able to use it. Frankly, in order to do your own custody, in order to hold your own keys or hodl your own keys, prior to about 2016, 2017, you really needed to be an engineer. Or you literally had to write it down on a piece of paper and just, tear up the piece of paper and hold pieces, your recovery seed in multiple places. That's about as far as a non-engineer could go. And then came the hardware wallets. And those obviously revolutionized custody for the previous bull run. But the problem with those hardware wallets is that they are a single point of failure. And what we've experienced is in a couple of cases, they've deprecated the software. And so folks who stuck them, squirreled them away in the proverbial, mattress somewhere and didn't go update the firmware on the devices, all of a sudden had problems using the devices years later. And so one of the most important things that I think a lot of folks learned is, hold an archived copy of the software, because it's possible when you pull your device out years later that the old software won't even be around anymore. So you've got some single points of failure, and those were not multi-sig. So now we've actually got a multi-sig arrangement, thanks to Casa and some others who are setting it up for non-engineers to use and have spent a lot of time working on the user interface. The way Avanti plays a role in that is that we are an institutional provider of custody. What does that mean? Institutions, under most laws in the developed world, are required to hold custody in a third-party custodian. It's not an option for them. And this goes back to the 1940 Investment Company Act, which requires asset managers to segregate the custody of the assets into a different organization than the asset manager who's making the decisions about where the assets go. And like all laws like that, there was a good reason why it was created. There was a lot of fraud, especially during the Depression, where stocks were in paper form, and the custodian that was custodying the stocks and bonds, sometimes in bearer form, would literally make off with them, and there was no way to recover them. And so now that we're going back to bearer instruments, which is what crypto is, it raises the whole custody question. And institutions, by law, in most cases, can't self-custody or can't hold the assets themselves. But the other practical reality is, even if they're not required to, they're not operationally set up to handle self-custody. So what's happening is we've got the custody solutions like Casa on the individual side for non-developers, where you actually have the ability to use the strongest nature of custody, which is a multi-sig arrangement, where you really are in control, even if you don't actually have complete custody like you did when you wrote it down on a piece of paper, or when you had a hardware wallet to store your private keys. And then on the institutional side, we've got the modern version of that coming with Avanti as well.
Right. So Caitlin, I want to follow on what you just said and ask you if that means that not your keys, not your coins just doesn't apply now to institutions. Or how does it apply?
Well, it depends. The answer is it can. So if you go back and look at the stories that were written about Fortress's early foray, Mike Novogratz in 2013, I believe, started buying Bitcoin at Fortress. And it was actually, the private keys were on a laptop in the CFO's desk. And they built a little pod for the CFO and put all kinds of cameras and alarms around it and extra security in his desk. And that's where the private keys were stored. And that's because there were no third-party custody solutions back then. And a hedge fund that serves high net worth individuals like Fortress was able to, because they weren't technically required to hold assets in a third party, they could actually be compliant with the law and self-custody those assets. That is, again, not, though, the risk that most institutional investors can afford to take. So it's possible that you have folks like Fortress who are sophisticated enough and have the correct security around the storage of the private keys in their office. But think about the single point of failure issue now that we know what it takes to store a private key safely. Back then, everyone just probably thought it was a regular laptop, and nobody really understood the value of what was inside that laptop. We know so much better now how to store private keys in a secure fashion. And of course, multi-sig and time locks are the software upgrades that were implemented in Bitcoin since then that help facilitate that. So we can no longer have to have a single point of failure. And most institutions just don't want that operational risk, even if they're allowed to take it.
Right. So maybe, thank you for that. So maybe taking a step back, both Casa and Avanti are new companies, given where we're at in the market. So last time we were at this point of the market, Casa didn't exist in its current form. Today, Avanti didn't exist, so you were both doing essentially the same work that you're doing today in terms of the trend and the technology that you were pursuing. Nick, can you present to us, or can we take a step back and actually talk about what Casa is today and what Casa offers in terms of value proposition for folks that are, for Bitcoiners that get the tech, and then for folks that will be coming in new to the space in this market?
Yeah, sure. So Casa was started because we realized that private keys were, one, critical to the success of Bitcoin. They're the foundation of everything you do with Bitcoin. But two, they were way too difficult to secure. You know, when you're having to put your key on a laptop and then point a bunch of cameras at it and hope that nobody breaks into it, that's not something that the average person is going to do to really store a lot of value in Bitcoin. And so what Casa was built to do is to bring basically the best practices around self-custody and managing your private keys to the average person who wasn't going to go through all of those really difficult and sometimes technical steps to protect their Bitcoin. And so go ahead.
Well, I was going to say, so you and Caitlin now have both referenced Casa as a product for the average person or someone that doesn't want to or have the ability to go through the steps required to secure your keys. But as someone, so to disclose, I'm an investor in Casa and I'm a massive fan of Caitlin. So I have bias in both of these conversations. Casa is a product that's used not just by folks, you know, by grandmothers and grandfathers that are trying to figure out the simplest way to secure their Bitcoin, but it's also used by some of the most sophisticated Bitcoiners out there, including technically sophisticated Bitcoiners. And so I want to understand, I guess, the value proposition from that full perspective. So yes, it's a lovely UI and UX and very secure multi-sig. Why are people that could do this themselves also using Casa?
I think it's really about time and what is the value of your time, and then what is the value of your kind of mental peace of mind that your Bitcoin's secure. So one of the things that Casa, I guess, has brought into this that really didn't exist before with self-custody is this super high level of customer service where we've really tried to think of everything for you. And this just gets towards what I think was, you know, is really missing in Bitcoin generally, which is, yes, not your keys, not your coins. You are your own bank, etc. But that doesn't mean that you don't want a private banker who's your security consultant to handle everything for you, to help you when you have questions. And even though you may be technically kind of advanced enough to self-custody, to do all of this yourself, you may not want to spend the amount of time that it actually takes to do that right. And so that's another angle where that's why we have people who have been in Bitcoin for a long time using Casa as well.
Right. And Caitlin referenced one of the risks that has emerged as apparent between 2017 and 2021, which is the degradation of a hardware device through, you know, either through method of storage or through lack of updating firmware. How does Casa help? Can Casa help folks in that situation? So are you hearing the same sort of experience at Casa that Caitlin referenced could happen as the market shifted from relying on a single hardware device to secure your Bitcoin to perhaps multiple devices or a multi-sig solution?
Yeah, so we definitely hear that from people who maybe have had Bitcoin for a long time, exactly like Caitlin was saying, sitting on a hardware device that they then they're now touching it for the first time in 5 years, and they're booting it up again and realizing all these problems that they've got with the actual software side. And so this is why one of the big things that we've tried to do to make Casa easier is actually to encourage people to regularly interact with their private keys. We think this is something that you should be doing. It's kind of like, you know, your private key hygiene, where you actually, the old model was put it on a metal plate or put it on a ledger and never look at it or touch it again because you're too afraid to mess something up. What we're trying to change that to is you should actually be checking in on this quarterly, like every couple of months, to make sure that your keys are healthy, your software is up to date. And that's like making sure that your home security is up to date or something like that. It's just kind of a good practice for people. And the trick is just making it more of an acceptable regular practice by making it really easy to do.
Right, that makes sense. And so, Caitlin, so Nick has talked a little bit about how Casa is able to keep their customers up to date in terms of best practices, how to manage their keys, how to manage their hardware, and also what they should be paying attention to in the self-custody space. Can you talk about how Avanti does that for your client groupings? How do you keep, there's a lot to be, I have the unfair advantage of being able to reach out to you and Nick when things are changing and to have you hold me through the changes. How does Avanti do that at scale for clients, and what can clients expect from Avanti in this really dynamic environment of custody?
Sure. We're not operating yet. And so we'll be releasing a lot more information about our security model and specifically our authentication model. That's what we're really talking about here. We'll keep the keys secure for institutional customers on our end. It's a different model than the Casa model, but it does have a couple of very important similarities. It's multi-signature and multi-party and multi-device. So that's how you get the security. And that actually works really nicely with institutions, because most institutions have multiple people who have to sign off on transactions, especially if they're large. If you're talking about, multi-$100 million payments, that typically goes through 6 or 7 authorizations at a big company, for example, before the cash can get released, right? And so the concept here is each one of those can have what is effectively like one of the Casa Key Shield multi-sig devices, where you're just basically taking the operational procedure that's been there for time immemorial, who has access to the cash, who has the ability to release the cash, and you're basically mapping it to a multi-sig, multi-device structure, which is what helps ensure that the authentication, when there is an instruction given to move the assets, to use the private keys to move the assets, that authentication was valid and it was actually the customer who owns the asset that is giving the instruction.
Okay, so can you share a bit with our audience today what Avanti offers by way of value proposition for the folks that you'll be onboarding at launch?
Yes, we're again focused on institutions, and we're focused on Bitcoin custody, and we're a bank. That's a bit of a misnomer. I'm sure a lot of the folks in the audience are cringing right now. It's a bank, but what I understood a few years ago was that you're going to need to be a bank in order to be a true full-service crypto provider in the United States. And here's the reason: that all US dollar payments have to ultimately go through a bank. And if the crypto industry is not connected to banks that have direct access to the Federal Reserve, then that becomes your single point of failure. You can have the absolute most secure hardware approach to securing your private keys, but if you cannot convert your crypto assets to fiat, and you need fiat for whatever reason, whether it's to pay your payroll or pay your bills, or just you're trading and you need to go in and out of fiat, then that becomes your attack vector. I like the way Ryan Selkis put it in his annual report a year ago, that the single biggest attack vector on the crypto industry globally, in his mind, was the FDIC insured banks, because there are only a few of them that will do business with crypto companies, really just 3. And if the FDIC ever cracked down and said you can't do this anymore, then where would the industry be if we lost access to US dollar financial services? That issue is still there. And part of the reason why we set up the special purpose bank charter in Wyoming is specifically because it's not an FDIC insured bank charter. We don't have that FDIC risk in Wyoming's banks. So now we're back to, all right, what's the value proposition for institutions? Well, we've already established that not your keys, not your coins doesn't apply to some institutions by law. They have to use a third-party custodian. So now the next question is, well, what type of third-party custodian do you trust? In most cases, it's going to need to be a regulated one. If they're a registered investment advisor, or if they're an investment company, they absolutely have to use what's called a qualified custodian. Only certain types of financial institutions fit that bill. Banks are the ones that do fit that bill. Then you have this whole question of where's your good control location for your asset for auditing purposes. Banks have special exemptions in some of those rules. Banks don't necessarily care whether the crypto asset is deemed a security or not. So there are layers and layers of regulations that we have to deal with. But part of the value proposition to the crypto industry generally of Avanti being a bank that is hopefully soon plugged directly into the Federal Reserve, that's the last piece we're waiting for, is that we therefore can provide the pipes to the US dollar system for those who need those pipes to go back and forth, to create a compliant bridge between the crypto industry and the US dollar industry. You can, one of the beauties of crypto is you don't have to deal with intermediaries if you don't want to. You absolutely can be your own bank. And so some folks have asked me the question, wait a minute, why are you building a custody business when you're a big proponent of Proof of Keys Day, which we just had earlier this week on January 3rd? And the answer is those two things are not contradictory because institutions have no choice in a lot of cases. And so what we're trying to do is make it so that we have a crypto controlled fiat on and off ramp that services the crypto industry directly.
So Caitlin, go ahead, Nick.
Sorry, Caitlin. I had a question that I just thought of that I think it's interesting. How does an institution know whether they can self-custody or not? Is there a clear line that says, here's the rule of when you can self-custody and when you can't?
Yep. If they're an investment company or a registered investment advisor, they absolutely have to use a third-party custodian. And so that basically is pretty much the entire asset management industry. Hedge funds have exemptions. So there are certain types of asset managers. So a mutual fund, a pension fund, they pretty much have to use a qualified custodian by law. But then one of the interesting things about the asset management industry is that because that was such a forceful law and it covered pretty much everybody in the asset management industry, it became commonly accepted practice for everyone to do it, even if they didn't have to. So for example, insurance companies technically don't have to, but they do because it's a best practice. Pension funds and endowments, same thing. They're not always subject to those laws, but for best practices purposes, they chose to set it up that way because the entire service industry around them, all the post-trade analytics, all the auditors, all the custodian, the securities lenders, they're all plugged into the custodian. And so the answer is the whole industry basically followed the exact same model, whether they had to or not, because it was best practice and there was no alternative to support custody of bearer assets. It's one of those things. If you ask your stockbroker, call up, Charles Schwab or Morgan Stanley, if you have a brokerage account, and tell them you want a paper stock certificate for your Disney share. Disney's the one that's typically, most people want the paper stock certificate because they want to give their grandkids, the Mickey Mouse or Snow White on the piece of paper. I've got you a share of Disney for your birthday. If you call up your brokerage firm and ask them to give you your paper stock certificate, they're going to tell you no. And if you call them and say, I've had one, my grandparents gave me 30 years ago, it's been sitting in my safe deposit box, I want to now cash it in, they're probably going to say, we don't know what to do, because the operational processes around bearer instruments have long ago been lost in the securities world. And we're now bringing them back. And what's fascinating is for the endowments and foundations that the lead investor in Avanti is a university endowment. and they're big supporters of crypto, and they're facing the very real operational issues of how do we deal with a custodian for these assets? Because the crypto industry custodians are not plugged into our securities custodians. And so how do we deal with the audit trail? How do we deal with the accounting that has to be done? And operationally, how do we control this? When I started donating Bitcoin to the University of Wyoming in 2017, we ran into the bad money transmitter law that was a problem, in the state of Wyoming that you're probably familiar with. But what was interesting is that once we got that fixed, and then they went and got a crypto service provider who could liquidate their Bitcoin for dollars because they weren't authorized to hold the Bitcoin, and all these operational issues were real. So they just, every time somebody donated Bitcoin, they liquidated it to dollars. They couldn't find a service provider who would meet institutional custody, institutional standards. From an audit perspective, from a control perspective, all these things, there's just a lot of process around institutions. So it's not just laws, it's also just best practice. There's just so much liability for these fiduciaries that they dot I's and cross T's. And what we've seen is that there's a culture clash between the crypto industry and the institutional world. The hedge funds can take some risk, but you start talking about the really big money, which is the pension funds and endowments, they can't take those operational risks. They need all the processes to be buttoned down. And a lot of it has to do with the liability for the fiduciaries.
Right. So, Caitlin, that's interesting because it makes me aware that you're going to be dealing with a couple different groups of clients. And so you'll be dealing with those that are quite sophisticated and are crypto institutions themselves define themselves that way. And you'll probably be dealing with folks that are just getting used to what it is to hold a bearer asset. And I wonder how do you think about balancing that? How do you think about in a really active regulatory environment where things will be changing? And I imagine that Avanti will be needing to be really actively responding to dynamic regulations, and sometimes regulatory guidance that seems to be even in contradiction directionally with one another. So when you're dealing with these different groups of folks, both those that might have an opinion on regulation and know what they're doing, and then those folks that kind of want to be more hands-off, how do you meet both of those needs?
Great question. And I think where you were starting in the beginning with the evolution of crypto or of custody for individuals is going to apply to institutions. So if you think back to the last bull market, what did everybody do? Well, go back to the previous one, right? Everybody was at Mt. Gox. Well, we all learned our lesson, and I lost money at Mt. Gox. Okay, so to me, I considered that to be cheap tuition because I needed to learn my lesson. Not your keys, not your coins, and it was a valuable lesson. And I wrote that off, and and learned from it. And then what happened in the last bull market? Everybody kept their coins at Coinbase or Kraken or other centralized exchanges. Well, then we had to kind of have the not your keys, not your coins, proof of keys education process that a lot of Bitcoiners, all of us included, were actively a part of, trying to let folks know, if you're storing your keys at a custodian, you don't own them, and you really haven't created, what you own is an IOU, by the way, legally, and you really haven't created anything better than what you have now, where when you put money in a bank or you put securities in a broker, you don't own them. The bank and the broker owns your money and they owe it back to you, or owns your securities and they owe it back to you, right? So we had to do all that education. So that is important background for understanding where I think this is going to go, because the Casas of the world weren't invented yet. Frankly, the hardware wallets in the previous bull market weren't invented yet. We've had lockstep, huge increases in the services that have been available in each of the the 4-year bull markets. And I think that's going to happen here too, but it's that model is evolving. Like, we're starting now with everybody's holding their coins at Coinbase or Fidelity, or those are pretty much the only institutional custodians that are available, that are used to dealing with institutions and can do the kind of reporting that I was talking about earlier, and the audit trail that institutions need. Well, in the next bull market 4 years from now, we're going to have another version of the Casas and Avantis. And I hope that both of us end up evolving into whatever is the next the next evolution of it. And I think it will be kind of like we all started as individuals by depositing, especially if we weren't developers, we were depositing at centralized institutions. I think that evolution from use a centralized custodian to, I'll start self-custodying, that happened in the previous bull run for individuals. That same path is going to be followed by institutions. Right now, everybody has to custody at a third party because they're not set up operationally to handle it. But they will start building those processes, especially as we start to see more crypto assets, the more traditional assets issued in tokenized form. I do believe that the securities industry is going to go tokenized, and it's going to take maybe a decade to get it done. But the world will change. We will no longer have these layers of intermediaries and all this centralization in our custodians when we get to that point. And so we have to therefore build the operational processes within institutions to be ready to self-custody. It's just not there yet. And just like Casa is a new company and it's the next evolution of custody for individuals, there will be the next evolution of custody for institutions in the next bull run.
Okay, well, that's really exciting to hear. I'm glad that you have that level of optimism given the network you have in the regulatory space and the insight you have there. Can we switch it up a bit and talk a little bit about how custody drives adoption? And so Caitlin, you kind of walked us through a timeline of the friction points that we've gone through in the past, right? We've trusted custodians, both, kind of the, shadier custodians, for lack of a better term. And we've seen problems there. We've trusted the, more grown-up version of custodians, and there's also been friction or very apparent trade-offs in and what they offer and versus what they take away. But now we're looking at a world where you can self-custody and you can have a greater selection of choice in how you custody. What does that do for adoption? And do we believe that any of the activity we're seeing today in terms of new users coming into the space, both individuals and institutions, is any of that driven by the maturation of the custody space?
100% it is. Yeah,
I
absolutely.
totally agree. One thing that's interesting to me, this is actually more on Caitlin's side, but I'll say real quick, is that without the institutional custodians that have been created over the last couple of years since 2017, we actually wouldn't be able to have some of these big insurance companies putting in 100 million into Bitcoin. They previously were in that state where if they even got Bitcoin, they had to immediately liquidate it because they didn't know how to hold it. And then on the individual side, what's interesting to me is that the growth in better self-custody solutions actually, I think, changes some things psychologically about the adoption of Bitcoin. And so previously, your option was maybe keep it on an exchange for the majority of people. And so when your Bitcoin's on an exchange, it's a lot easier to just think of it as this kind of speculative investment asset that you can sell at any time. And what's different about when you actually take it into your own custody and hold on to it as money that you really own is you start thinking of it more as a long-term savings asset, Bitcoin as savings technology, that you didn't really necessarily think of it that way when you were holding it on Coinbase. And so when you're holding it with Casa or one of the other forms of self-custody, the actual psychological relationship with Bitcoin can change subtly. And I think that can change how individuals adopt the usage of Bitcoin, because suddenly it's real money. It's not just this speculative investment.
That's a great point, Nick. Thank you for bringing that up. Caitlin, it looked like you wanted to add?
No, I think it's a great point. I'm vehemently agreeing that advances in custody are making it easier for everybody else, because everybody goes through the same process, especially if they're not a developer, which the vast majority of users of Bitcoin are not. And they start with, okay, how do I get it? Well, you link your bank account to I started back when I got it directly peer-to-peer from somebody, and local Bitcoins was still operating. But now most people actually get a Coinbase account. They link their bank account to their exchange, and they buy it, and then they may never actually take it off. We're starting to get to the point where people will take it off, and there are service providers like Casa who will provide a means by which they feel comfortable doing it if they're not engineers. And that same evolution is going to happen, I think, for the new users, because there have been different waves, right? Bitcoin started with the cryptographers, and then went to the libertarians, and then went to the maybe the gamers were in between the cryptographers and the libertarians, and then went to kind of the edgy Wall Street, hedge fund gang, and now we're moving to the more traditional, endowments, pensions, mutual funds, that kind of thing, right? So that you've seen that evolution of users. Each one of those new user groups goes through the same evolution of, I have to start by getting it at a third-party provider, and I'm probably just going to leave it there. Well, then maybe I shouldn't be leaving it there, because what happens if that institution goes bust? I've got too much counterparty risk to them. So then they actually teach themselves self-custody. And then once they teach themselves self-custody, that's when they start looking for who are the best providers. So I think the next evolution for institutions, probably in the next bull run, I'm talking about 4 years from now, is probably going to be that they're going to be multiple banks that actually provide key management services, but don't directly provide custody services. So that's probably, before people self-custody as an institution, they'll just have 5 different banks, and there'll be a 3 of 5 multi-sig where they'll deal with 5 different banks, and they will all be online 24/7, 365. So you can continue to trade 24/7, 365. And you're just using a multi-sig service. This gets back to what banks should be. Banks should be money warehouses. They should be service providers. They should not be counterparties. We should not be forced into turning over our assets to our counterparties. But the services that banks provide, as much as we like to joke about the banksters, Pomp likes to say, short the bankers. The truth is the banks do provide a lot of valuable services. And even in a perfect world, they still would. They wouldn't go away. It's just that they wouldn't be counterparties. They would just be service providers.
Yeah, excellent point. I'd love to continue this conversation for a couple hours at least, but we're in the last few minutes. I don't want to allow this conversation to end without talking about the trade-offs directly that people experience when choosing between a custodian and self-custody. So of course there's pros and cons to both. We've referenced that indirectly throughout the conversation, but what I'm seeing from newbies today, and I imagine you are as well, is questions around why they'd use Coinbase and why not. And I'm sure that institutions are thinking about their long-term in a similar fashion. Can we spend a few minutes on just that, looking really starkly at the trade-offs? What does someone gain from self-custody? What do they lose? And when you're using Coinbase, what does that mean? Caitlin's walked us through a bit about that being an IOU versus a Bitcoin. What are the implications of that? Nick, do you want to kind of kick us off?
Sure. Yeah, so I think that starting with the pros and cons of self-custody, the benefit is that it's not an IOU. It's literally money that only you have control over, because you're holding the private keys. And cryptographically, that's giving you the only form of control and access to spend that Bitcoin, which is really important. It's like having cash that only you can decide to spend that cash. On the flip side, one of the I guess you could call it a con, but in a way I think it's a pro in some aspects, is that this just means you have a lot more responsibility. And so it means that you're not trusting some third party to hold your Bitcoin for you. You have the responsibility to not lose that Bitcoin. And so just like let's say you've got a $20 bill in your pocket and you accidentally drop it on the street, you can't get that back unless you happen to go be able to find it. But let's say you can't. So you can't get that $20 bill back. Whereas with using like a bank, if I send a transaction that I didn't mean to, I can call up the bank and say, hey, could you reverse this? And so it's a trade-off between the amount of control that you have versus the amount of responsibility that you have or desire. And for some people, having that responsibility is a great thing. Like for me personally, I like the idea that I am the one who has responsibility for securing my savings. On the pros and cons of the Coinbase, using a custodian like Coinbase side of things, you get initially, I would say, you have this kind of warm and fuzzy ignorance feeling that Coinbase is handling this for me and they're going to do a better job than me. But in the end, it's on the con side, it's really more of a black box. It's saying, do I trust that this custodian is doing a better job with my security than I would do with my own security? And that's something that when you talk about these bearer assets like Bitcoin, and you're coming full circle back to this bearer asset model, it's just a little bit different than how our current system is today that people are used to.
Okay, so the practical implications of having Coinbase, or the Coinbases of the world as your intermediary that that can call back, or protect you in some way. Can you talk a little bit about that? So specifically, I'm thinking of things like people who custody Bitcoin with Coinbase. In the last bull market, we saw a lot of coin drops or chain splits, forks, where you would gain access to an additional token if you were holding Bitcoin. I'm kind of like leading the witness here, Nick. Do you want to pick that up, or
Yeah, sure.
My concern is this: Coinbases of the world are a really attractive option for folks coming into the space for the first time. It's unclear to me that people understand what they can't do, practically speaking, when they use a custodian. And I want to make sure, and I know one of Casa's key agenda items is to make sure that people understand what you can do with Bitcoin and the trade-offs in how you custody. I want to make sure that newbies are making decisions fully informed. So I've led the witness a little bit here.
The specific instance you're talking about was basically that when Bitcoin would fork in 2017, the new currency would airdrop whatever their currency was to all the current Bitcoin holders. And if you weren't holding your Bitcoin, if somebody like a custodian like Coinbase was holding it for you, you had to rely on them to give you access to that new coin that was given to you. And so it's the whole underlying theme of what you can't do when you're using a custodian is you just have a lot less flexibility with what you can do with your own money. You can't necessarily get immediate access to something like an airdrop. You can't necessarily move your Bitcoin as quickly as you might want to, and as quickly as you could compared to self-custody. They could even restrict ways that you would move your Bitcoin for kind of regulatory reasons. So there's a lot of different things where you simply just don't have real ownership of your money. And so you are asking somebody else to do things for you with your money. And I think one thing, the second big risk, which I'll let Caitlin touch on because she brought it up earlier, is like the Mt. Gox type of risk, which is the actual loss potential.
Yeah, I was just going to add, actually, I think the counterparty risk is a huge one. I worry about that because I'm a balance sheet focused person. I worry about risk. I worry about the catastrophic risk, and I want to close off the potential catastrophic risks in my financial statements, my own personal balance sheet. And we've seen failures of custodians, and the honest truth is no one has a clue whether any of the custodians, Coinbase included, are actually solvent. Bull markets can cover up a lot of sins. And what we saw in Mt. Gox, and we saw it in Quadriga, and we've seen it in the failures of other smaller ones, is that those institutions were insolvent for a long time before they finally hit the wall. And it's interesting to go and look at, what happened in the price action to try to learn from it so that you can kind of see what's going to happen in the next one. Because I guarantee there are many institutions in the crypto world that are not solvent, and we just don't know it yet because the bull market has covered it up. A perfect example of this is the really weird situation that happened with the Mt. Gox bankruptcy. That institution is not bankrupt anymore. Most institutions, when they go bankrupt, they literally have to liquidate and you get pennies on the dollar back. Well, the weird thing is that even though they were actually insolvent, Bitcoin's price ran up so much that even though they had maybe, I don't know, 20% of the actual Bitcoins in their portfolio, but the Bitcoin price has run up so much that the institution itself, again, in terms of, if you think about the fiat value of their obligations, they're now solvent again. This just never happens in the bankruptcy world, where suddenly the assets on a bankrupt institution's balance sheet go up so much in value that the institution isn't bankrupt anymore. Now, technically, they're still in a receivership process, but we're all going to get our money back. But we're lucky because it's not because we got the value of the Bitcoin back. We got the value of the US dollars in Bitcoin back, right? So we didn't lose money in US dollar terms, right? It was a lot less good, right? But the point is, like, that should drive the point home that, okay, we've got a lot of institutions who are playing fast and loose behind the scenes and are not solvent. They are not 100% reserved. We have no clue if any of the institutions we're dealing with are actually solvent. And that bull market in Bitcoin is covering up for a lot of sins. As Warren Buffett likes to say, when the tide goes out, you see who's swimming naked. The tide is going to go out at some point. And we see these cycles, right? Every time you actually see a price correction, a significant price correction, or you start to see real supply shortages, those are the equivalent of the tide going out, and we start to see who's swimming naked. And the Quadrigas and Mt. Goxes, there's a saying in financial institutions, in the financial world, you can stay liquid a lot longer than you can stay solvent. And those organizations were liquid a lot longer than they were solvent. And once they finally went illiquid, that's when they hit the wall. And you realized in retrospect, they were insolvent all along. There are many of those, I believe, in the crypto industry right now, and we just don't know who they are.
And I think just to bring that home to why it's important for individuals to think about holding their own keys is that when these institutions go solvent, there's no getting your Bitcoin back. The Bitcoin, when they go insolvent, the Bitcoin that you are holding with them is gone. You lost it. And so that's, if you're thinking Bitcoin's going to appreciate 10x or more from where it is today, you benefit a lot from taking your security into your own hands. I mean, another example of you don't know what institutions are doing with their keys is from OKX, actually, which happened in 2020. One of the OKX founders was arrested by the government for unknown reasons, and it was in Asia, and they basically had to suspend all withdrawals of Bitcoin. You could not remove your Bitcoin because that founder held the key to let for everybody's Bitcoin. And so their security practices were so terrible that one person was able to knock out the ability for all of their customers to move Bitcoin. And so these are some of the things that people just, when you get that warm, fuzzy feeling of ignorance that somebody is doing a better job for my security than I am, it's usually kind of a false veil of ignorance that you're putting for yourself. And there are a lot more risks than people realize.
Yeah, that makes a ton of sense. And thank you for outlining that for us, Caitlin and Nick. I want to end with one of the questions question themes that's been surfaced by the audience today, and that's around regulation. And of course, we have one of the sharpest minds in the field on regulation, which is Caitlin Long, with us today. And so we can't have the subject pass without addressing it. I'm going to frame the question the way the audience member framed it, and then we can kind of riff on it a bit. So this is Casa Focus Next. So the question is, does Casa, with recent developments in US regulations, as a collaborative custody service for multi-sig Bitcoin storage, present a potential privacy risk? Can Casa be compelled to provide customer data which exposes either customer addresses, meaning Bitcoin addresses, or any other sort of identifying information to the government from customers? Can you kind of walk us through? So I'd love to, we'll take the liberty to run over a bit, and I hope answer the question in two ways. One, from Casa's perspective, is Casa a privacy risk to folks? And then from a kind of 10,000 foot view, Caitlin, if you could, talking to us about how your viewpoint of how recent regulatory guidance impacts custody. Nick, we'll start with you on the micro.
Sure. So this is something that, as you mentioned earlier, is always evolving, but our position right now is basically that Casa is not a custodian. We give you software to manage your own private keys. And so the individuals are actually custodians in this respect. And so Casa, from that angle, is not required to KYC our customers. We're not required to provide any sort of reporting to the government about our customers, just like, a normal app developer would not be required to provide that kind of information. And so for us, that's something that we do not regularly report customer information, and we would fight any sort of request for that type of information. The second thing that I think is important is that Casa's made ways for our customers to actually use our service in a very private way, so that even if something like that were to occur where we had to give up some level of information, which, as I said, we would really push back against, the actual amount of information that we can give up is very little, and it's not even personally identifying information. So that's something that, basically with any type of self-custody provider, there's always these kinds of different types of information and trade-offs that you're providing to that software provider. And so there's always going to be that question of, can the government try to get this information? And it's about what you and the software provider are doing to try and protect your privacy as much as possible.
So does that mean that I can come to you under a synonymous identity and access the collaborative custody solution that you're providing?
Yeah, and so I think basically we actually have a full blog post on how to do this, but you can sign up with a email that doesn't have your name in it. You don't have to give us your name. We don't perform KYC. You can come fully pseudonymously and still use all of Casa's services, because as a non-regulated company, we are not providing custody services. We are actually just providing key management. So we don't even necessarily call it collaborative custody. We call it key management. That's really what we are enabling our customers to do. And so that's something that I think is important to really distinguish Casa even from some of the other solutions out there, where you actually, even though it's just key management, you do have to go through KYC, that kind of thing.
Mm-hmm.
Great. Thank you, Nick. So a true cypherpunk spirited company with Casa. Yep. Caitlin, can you give us the macro on this? Can you give us the 10,000 foot view on what recent guidance, regulatory guidance, means for custody?
Yeah, well, I'm sympathetic to that view, because I do believe that these are bearer instruments, and the challenge is that the moment you want to touch the US dollar financial system, you're going to have to go through KYC. That's the law. So you can self-custody your crypto, and I'm a big believer in that, and big believer again in own your own keys. But the moment you want to touch US dollars, the banks are required by law. They're effectively through the Bank Secrecy Act deputized to collect all that information and have to hand it over to the government when the government asks for it. It's the same thing as your cell phone companies. You don't have any privacy in your cell phone location data. The cell phone companies are going to turn that over when the government asks for it. So it's just a fact of life, and I think both systems can coexist with each other. One of the questions that may be implied in the audience question is the Mnuchin rule, which is going to require the use of the KYC to expand to self-hosted wallets. And the entire industry, ourselves included, has been working against that, precisely because the honest truth is that law isn't going to accomplish the ends that the proposers think it will. Specifically, in order to they want to be able to have KYC on all the self-hosted wallets. Well, the easiest way to then preserve privacy, to beat that law, if you will, to beat the new rule, is just to take your coins and move them one more hop to a wallet that hasn't been KYC'd yet, right? And so you're not really going to actually solve the law enforcement goal of stopping crime and terrorism financing. Those are laudable goals, and I absolutely support those. The challenge is that the proposal doesn't accomplish those, and what it really does is just throw sand in the wheel. So if you look at the cost benefit of the inefficiencies that US users are going to have to go through in order to comply with that rule relative to the law enforcement gains, the cost benefit math is really ugly. By the way, that's been true of the Bank Secrecy Act historically as well. If you look at the conviction rate for money laundering, going all the way back to the 1970s when the Bank Secrecy Act came into force and was challenged in the courts and upheld at the Supreme Court, it literally was the conviction rate is I think it's 0.24%. It's a very, very low conviction rate. And so obviously Congress is not interested in the cost benefit math, but if they were looking at making good public policy, they would look at the pros and cons and realize this doesn't actually accomplish the law enforcement end. And what it does do is throw a lot of sand in the wheels of using crypto. But all that said, it doesn't, crypto is, these are private assets if you want them to be. The vast majority of users will not want them to be, and anytime they want to touch the US dollar system, you have to go through KYC. It's just the law. If you don't like it, then I've proven that you can actually get laws changed, and so start working on it, especially with your congressmen and senators, and start letting them know these are not laws that you support.
Yes, and Caitlin, what about the OCC's interpretive letter 1174 that just came out 2 days ago, I think, around yes, and node use?
Yeah. Oh, well, that's great. That makes it clear that banks can operate nodes. Again, if you start to think about the fear factor of will crypto be outlawed, well, now you've actually got the national bank regulator saying that banks can operate nodes on blockchains. That's a positive. I didn't say much publicly about this because, of course, I'm in the middle of some of this. But one of the interesting things, basically, that interpretive letter from the OCC is truly a double-edged sword for the crypto industry. One of the interesting things about it is that the way bank regulation works is that the large banks don't have to go ask for permission to do something that's not material to a material change to their business plan. So the impact of what the OCC just said is that the JP Morgans and Citigroups of the world can now go issue stable coins today, if they want to. Whereas everybody else, all the crypto startups and smaller banks, have to go ask for permission because it's either they're not licensed to do it or this is deemed a material change to their business plan. So this is definitely a double-edged sword. This handed the very largest banks in the United States an advantage, but the only way to get that extended to the smaller banks was to do what the OCC did and give them that advantage. These are network effects businesses. So one of the interesting things to watch, and the reason why when I tweeted about it, I said, we don't know yet how this is going to play out, is are the big banks going to come in and just elbow out all the crypto companies, the USDCs, the Paxos standards, and instead JPM coin or utility settlement coin are going to be the ones that get network effects because they have that regulatory advantage of being able to get there first. There were also a lot of things in that letter that gave me pause. Again, I know the jargon, and I know the attack vectors that I think are going to be used. I'm going to use a phrase that might make you snicker a little bit, but I think a lot of companies in this sector are going to get rippled. And what I mean by that is Ripple was allowed to operate for 7 years in a regulatory gray zone. And you know what? 7 years later, they realize, they got a regulatory enforcement action. There are a number of companies who are going to get rippled, and it may take 7 years. And it is what it is. If you're not complying with the law and you're skirting the law, you're taking an enormous amount of risk as a company. And the attack vectors for the crypto companies to get rippled but in this bank world were right in that OCC letter. There were catchphrases that probably went right over a lot of folks' heads. Consumer protection. What does that mean? You have to comply with something called Reg E, Regulation E, if you're dealing with consumers, which of course all the stablecoin issuers are. What is Regulation E? Well, it all has to do with consumer protection laws that mean that you actually have to acknowledge. If you think about your banks, you're acknowledging your fee disclosures. We don't have any wallet software that allows for the advanced acknowledgement of fee disclosures in the crypto world. So the fact that there are no, say, ERC20 wallets that have the ability to do a click-through acknowledgement of fees, well, now all of a sudden, the crypto companies, there's your attack vector for an enforcement action that's going to be coming down the line. They're not actually getting advanced acknowledgement of fees from their users. There was another catchphrase I'll give you an example of: deceptive practices. The UDAP is something called UDAP. This is the kind of thing that lawyers are always afraid of with any business, is you can't be engaged in deceptive practices, because if you are, an enterprising attorney general is going to come after you. Well, what is the number one deceptive practice that the enterprising attorneys general of the United States like to go after? It's fees. Well, now you're realizing that the crypto companies are not asking for acknowledgement of fee disclosures under Reg E, and so now you've just deceived your customers, and so you're going to get a UDAP action against you. Like, just the phrase consumer protection, I knew what a loaded phrase that was. There's another example. Safety and soundness. That is a indirect reference to the payment system risk. I'll bet you, I'm so deep in the weeds of payment system risk right now, because that is what safety and soundness is of financial institutions that plug directly into the Fed. There's a lot of payment system risk in the stablecoin world. By using the phrase safety and soundness, I knew, again, that's jargon, and most folks probably don't understand the significance of. But if you're in the bank world, that's a warning sign, right? So what I'm driving at here is there was a lot of detail in that OCC letter that effectively lays out what I think will be a multi-year attack vector on crypto companies that don't comply with those regulations. And there are companies that are going to get rippled in the next few years as a result. Like it or not.
Another interesting kind of angle that I saw in there was that I think they said that anybody using stable coins including self-hosted wallets, will need to follow Know Your Customer laws, which was something you were kind of touching on earlier, which is anytime you touch US dollars, you're going to have to require KYC. And that's something that maybe there's a lot of wallets out there that currently use stable coins that are not enforcing anything like that. And so I definitely agree. This is kind of a double-edged sword for a lot of companies. And Casa doesn't touch stable coins right now, but yeah, it's something that is interesting to watch.
So thank you both. We've exceeded our overtime also with the panel, but it's especially based on your responses to the last question. I think it's clear that audience members that are not already following you on social media should be. And so I'll send people there. I want to thank you both for your time today. It was really an honor to be with folks that are leading the way in custody, especially because custody drives adoption and gets us closer to what Satoshi offered us and promised us with the tech that he introduced now well over a decade ago.